Some pretty big news after the market closed on Tuesday, and that's that Robinhood authorized a $1 billion share repurchase program. Now, that's something that's been very common in public markets when stocks get undervalued or when companies have too much cash on the balance sheet. They say, how are we going to return this cash to shareholders? Well, we're going to buy back stock. Sometimes buybacks are a really good idea when you're buying stock at a discount, and it can basically provide fuel on the way up when the stock starts to rise. But sometimes buybacks are not a great idea because you're buying back an overvalued company. Robinhood is in a little bit of an interesting case because this is still a growth company, a growth stock. So you would expect them to be investing a lot of their money back into the business, into growing the business long term. But management has made the decision that, hey, we have about $5 billion worth of cash on the balance sheet. We might as well use at least some of it to buy back our stock at the level that it's trading at today. And the business continues to do pretty well. So I want to go through exactly what the buyback looks like, what management might be seeing, and then the latest trends from the business. Because we have not only the balance sheet, but also we have the monthly report from April to look at. So I'm going to cover all that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's look at the official release about the buyback. One of the things I thought was interesting is they did not release an official press release on their investor relations site about this $1 billion buyback. Instead, what they did is they released what's called an 8K filing with the SEC. This is that filing right here, and this is really the official document. A press release is great, but a lot of times press releases are just communications with investors or potential customers, kind of introducing products and things like that. But this is really the official document saying, hey, government regulator, this is exactly what we're planning to do. And this is the important part here. On May 28th, 2024, Robinhood announced that its board of directors approved a share buyback program authorizing $1 billion of Class A common stock. And there are always important details in here. This does not have an expiration date, but they expect to conduct the repurchase program over a period of 2 to 3 years, beginning in the third quarter of 2024. So according to this, they're not going to be buying shares until at least July 1st, 2024. And then this buyback program would last for a couple of years. Oftentimes they do these kind of blanket statements or blanket buybacks where you just say, hey, buy back X amount of stock every single month. And we're not going to worry too much about the price. Typically, an investment bank is going to handle that for you. You can also do what's called an accelerated share repurchase program. So let's say your stock gets really depressed in valuation. You could say, hey, you know what? Let's take that $1 billion buyback program and let's buy it all back tomorrow because we want to accelerate these share repurchases. So this is kind of a standard blanket buyback program. And why would they be buying back stock at the current price? Right now, this is pre-market on Wednesday. Robinhood's shares are trading up just slightly, so about $20.64 per share. In pre-market trading, market cap is about $18 billion. So buying back $1 billion worth of stock, going to be about 5% of the company outstanding. And the reason you might do this is because you have excess cash on the balance sheet. This is a look at Robinhood's balance sheet. There are a few pretty big liabilities down here, but these are related to running the brokerage business. Cryptocurrencies, safeguarding obligations. This is offset by the asset number up here, securities loaned and payables to users. These are offset by receivables from users and cash and securities segregated under federal and other regulations. So basically, no debt on the balance sheet to speak of. And there's about $5 billion worth of cash, $4.8 billion worth of cash and equivalents, and then about $400 million worth of held to maturity securities. Pretty clean balance sheet. But you can see if you have an $18 billion market cap and $5 billion worth of cash, it may be prudent for you to start buying back some of that stock at that current price. And that's exactly what management is seeing. They're also seeing a fair amount of momentum in the business and a couple of things to keep an eye on. Funded customers. This is going to be the number of customers you're going to be able to generate revenue from. That number is steadily climbing, now 24 million. But the thing that really sticks out to me is assets under custody and deposits. The deposit rate is just growing like crazy. And this is in part because of some of the benefits they're giving with the gold program. So there are some costs that come to attracting these deposits, but long-term, these should be profitable customers. And that correlates with a pretty big increase over the past year in assets under custody. Cash sweep also continues to rise, driven by the gold cash sweep. The margin book is up, options contracts traded is up, crypto volumes are up, although March was really an outlier quarter there, and trading for equities is up as well. But it seems like in general, you're getting more and more assets on the balance sheet. So that's going to be positive news for Robinhood's business long term. What I think you want to see is the number of users increasing, amount of assets that each of those users has going up. You want to be working with a little bit wealthier customers than just people who have a couple $1,000 in a trading account and are trading options. That was a lot of what their activity was during the pandemic. So now we're getting people funding Roth accounts. We're getting people moving millions of dollars into Robinhood accounts. It just matures the business, and it actually makes the gold product a little bit more valuable, because I think that's where they're going to make their profit, a little bit like a Costco model. Profit on the membership model and then run the rest of the business at more of a break-even level. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So is this the best use of cash today? Well, if you think shares of Robinhood are undervalued, then the answer is absolutely yes. Given the level of cash that they have on the balance sheet, I do think it's probably prudent to return some of that to shareholders or do something like an acquisition. Acquisitions don't necessarily make a lot of sense for Robinhood, because I'm not sure exactly what you would tuck in that the company wouldn't be able to do better just building itself. This is still a technology platform company. It's not just acquiring assets the way that a lot of investment banks or traditional banks are doing. So maybe acquisitions don't play the same role they did do in a lot of bigger banks. So maybe that's kind of off the table. The other option instead of buybacks would be dividends. Is it better to buy back the stock at the current price or pay maybe a special dividend? That can be debated, and we'll see where the stock goes long term. But right now, the bet is that the company's still in growth mode. The stock is undervalued based on that long-term potential of the company. So might as well reduce those number of shares outstanding, potentially reduce the dilution that comes from stock-based compensation. That's one thing a lot of these technology companies do, is they pay a lot of stock-based compensation, and then they'll say, hey, we're going to buy back stock in order to just offset that. I don't love that use of capital, because maybe just don't use stock as compensation, just pay that money in cash. It'd be a little bit more clear to investors where the cash is coming from. But all of these things go into the mix when you make this kind of decision. Obviously, the market, as I'm recording right now, is not having much of a reaction to this kind of buyback. But this isn't unusual right now. Investors know that there's cash on the balance sheet. They know that one of the options is to buy back stock. So sometimes buybacks aren't really cheered by the market. It looks like that's going to be the case for Robinhood. If shares pull back and we start to have this buyback accelerate, I think that could actually be a nice catalyst for the stock. So this is one that I've owned, that I'm adding to a little bit over time, and I'll probably continue to do that as this buyback program takes place. So I think it's a nice move by Robinhood, but I do want to still see the core business continuing to grow throughout 2024. But I think everything is on the right track for Robinhood right now. What do you think about Robinhood stock? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.